Hey everyone. So I wanted to talk a little bit about liquidity and inducement, what it is, and how do we use it. So ultimately, what liquidity is it's money. It's resting orders. So anywhere we see pivot points, such as this, there will be resting orders there in the form of stop losses and in the form of sell stops. Basically saying there's, breakout traders here, and if the market goes this way, they have a sell stop ready to go. Anywhere we have equal lows, or even if it's relatively equal lows, we can assume that this is some sort of liquidity and it will be run. We never know when it'll be run, but depending what the market's doing and how it's moving and what market structure looks like, we can start using liquidity for several things. We can start looking at it to see if it can be used to fuel a move, or we can start looking at it to see if we can target a pool of liquidity. So the other form of liquidity we have is what's called trendline liquidity, and what that is ultimately is resting orders underneath all the lower highs when we're heading up. On the flip side of things, you'll have resting orders on top of the pivot points when we're heading down. Any equal highs, any relatively equal highs, they don't have to be completely equal. It can be like this or it can be like that. To me, that's still close enough to equal that I will consider that as some form of liquidity. Ultimately, this is more of liquidity to me, whereas if I see something like this, then to me, this has swept this liquidity and should have fuel for the move. So we always look at how it forms, but relatively equal highs or equal highs, whatever you want to call them, to me, they usually get run. But something to keep in mind is this liquidity will be collected, but we don't know when. So just because we see liquidity, we can't assume it's going to get run today or tomorrow. It's just assume that the market's going to come get it. If it's nearby in the area we're currently trading, near the PA, chances are it'll happen right away. So that is liquidity we can use. Now there's different forms of liquidity. We have another form of liquidity called inducement. And what inducement is anytime we get an impulse away, we want that pullback and we want it to drop some liquidity. Now, when the liquidity is close to the order block like this, it is actually called inducement. The purpose of inducement is, the theory behind it is basically if the inducement's intact, this point of interest should be stronger. So just to give you an example, let's say price rocketed away and price came back right here, took that inducement, but it didn't quite tap this demand zone. It swept this inducement, but then it went on to make another high, taking this high. The theory behind inducement is the next time price comes down here, the chances of this order block holding or demand zone are quite a bit less because this inducement's no longer there. It's been taken. Whereas if the inducement's intact and we come tap it, we can expect this to be a fairly strong demand zone, provided, other confluences align and we're on the right side of the market. Now, liquidity does get a little bit more advanced, but it's not as bad as it looks. So there is the whole concept of internal range liquidity and external range liquidity. And the simplest way to explain it is every time we have a retracement, liquidity is dropped. The market will come and get these points. We just don't know when. Now, as the market comes down and it collects all of this liquidity, it's also doing something else on the backside. The market is also creating future trendline liquidity for the up move. Again, you can't assume that we're going to immediately go get that, but the concept of internal range liquidity and external range liquidity is Every time we hit one of these liquidity pockets, we'll likely get some kind of a retracement. Some will be bigger than others, depending what market structure is doing. In this case, we're bearish with external range liquidity, which is ultimately your liquidity on the edges. The concept is once the inside of the range has been wiped, we'll usually get a bigger move when the external range liquidity is taken. So a lot of times you'll see the whole range get wiped. Think of it as a bowl and it gets filled. And as soon as this liquidity void is filled, we can expect an abrupt move from the external range liquidity. Now, in the same context, all this stacked liquidity gets taken here, and in this particular example, we start going up and we're ultimately taking all this liquidity. At the same time, while we're doing that, we are dropping more liquidity. Now, this is something to add on to zone creation and range creation, and it kind of expands on the concept why the market ranges and what it does. But again, once we got up here and this liquidity void has been filled, even if we continue going up, chances are before the continuation you're going to see a very good reaction from the external range liquidity, and that's because this range has been wiped. So you'll see some sort of a reaction, and this will go on continuing doing this for basically ever and ever and ever. And every time we hit that external range liquidity, we can expect a bigger move than when we hit the internal range liquidity. So just to show this in a bit of an example, by the way, this works on every time frame too. So let's look at the 4 hour. We have some sort of a liquidity void here. It gets filled. Ultimately, you get a good reaction. You have, hold on, let's go in a 15 minute. We can even show it how it looks like day to day. And this happens over and over and over. And you basically pull your demand and supply zones, and every time these liquidity voids get filled and ranges get wiped, we can expect an abrupt movement away. Again, even if we go back to what we had here, even though the market was trending bullish, because this range had been wiped and we hit this external range liquidity, we got a pretty good reaction. So now, if we look at this continuing on, this basically goes on forever. The bowls get created, they get filled. As the liquidity void gets filled, the market moves away. Now, on the flip side of things, as the market moves away, you're going to get some kind of reaction to every time this external range liquidity gets filled. So here again, we get a good reaction. Here is another prime example. Again, your liquidity void gets filled, all the liquidity's wiped, the whole range gets wiped, you get an abrupt reaction, and you get your mitigation, and you get your entry. And for those of you that trade London, you'll notice a lot of these big moves, especially on Euro USD, seem to start in London. Now, to show you this concept on the simpler side of things, we'll look at gold here. So the concept is anytime we want to move away or we want to move, we want to basically either wipe a range or we want to take liquidity. So right here we have a demand zone gets created. This demand zone doesn't just get created. Take a look at this wick in particular. It comes down it completely wipes these 3 wicks, uses that liquidity to push away, break through this supply zone, and ultimately we are now changing momentum. So this was the last sort of point of control in the higher time frame where supply was in control. Demand broke through here, and ultimately we come retest this area. Now, this is something we'll talk about more in the future videos, but this is what you call a flip zone. Supply was in control, demand came into supply, we have a reaction point, and ultimately we start looking at what took out the reaction point, and we'll likely get a good reaction from those points. Now, if you look at the way the market moves, and this works on any pair, not just gold, you have a little liquidity void. This wick completely wipes it. We gotta move away. You come down, you kind of fill your liquidity void here. You drop some sort of equal lows. You wipe that liquidity. Again, you push away. Now, you start getting into different kinds of liquidity. You have your sort of equal lows. Those will get run. And you have your trend line liquidity. And ultimately we have 2 flip zones here, here and here. One of them is likely to get tested. Gold wipes this liquidity and the range liquidity, and ultimately we moved away. Again here, gold stacks liquidity, stacks trend line liquidity. Now I want you to make note of how price moves when we're stacking liquidity. Everything is very small moves up and down, and what's actually happening is they are stacking liquidity and they're mitigating everything. Now when everything gets mitigated and trendline gets stacked like this, for them to come through again, price can just melt. Whereas if we had some abrupt price action that went straight up like that, chances are we would basically come down, hit a zone, retrace, hit a zone, retrace, hit a zone, retrace, and ultimately that's because nothing's been mitigated in here. But when you have a zone of really tight mitigations like you do here, we're ultimately stacking liquidity. So with this concept in mind, gold is bullish on the 4-hour right now and bearish on the 15-minute. So as we get into a supply here, we fail to run it. You start getting a failed reaction here, and ultimately gold starts dropping down. Now we can start building a narrative that all this liquidity should be collected as 15-minute is bearish, and at a bare minimum, this liquidity here should be targeted. As we come down here and we start making our way down, now we can start formulating the idea also that this low is weak. It failed to run this high. And as you can see here, we wicked just below it and we took that liquidity. So if the market wanted to continue on from here, because we did come into relative equilibrium, the market can now continue on up. Or if the market chooses to continue on down, we are going to start looking at where is the logical place for it to come down. Well, we have liquidity here. We have trendline liquidity here. We have an unmitigated demand here and here. So if the market did start making its way down, my first target would be at a bare minimum this liquidity. This to me has already been wiped. This is mostly taken, so this would be my first target. And the reason it's important to make note of these areas is if the market starts heading one way or another, you need to formulate a plan of where it's likely to go. So with gold being bullish on the 4-hour, my expectation is that we are going to continue on up. It's not guaranteed that we're going to continue on up from here, but what I can tell you is that price did come into discount. We've taken a bunch of liquidity. That doesn't mean price can't come down here then continue up. Nothing in the market's obviously guaranteed, but big pools of liquidity, they can be targets, and they can be also used the opposite way of a target, in a way of saying our range is wiped. If the market starts showing signs of bullish intention here, we can say all the internal range liquidity has been wiped. We hit the external range liquidity, and now we got our reaction here. So whether it continues on up or it continues on down, we have a reason for the market to do either. And ultimately, if these demands keep holding, we're going to keep buying. If demands start failing and they start going and supply takes control, then the first place we'll short is here, and we can target this liquidity. So that's kind of the concept of liquidity without beating it over the head too much. On the flip side of things, inducement is something very similar. And the idea of inducement is, again, if it's intact, the supply or demand zone should hold. So here we have a push away. We take this high, we create a new 4-hour high, and we drop inducement. The next time we come into this demand, I expect it to hold, and we get some kind of reaction, so it held the initial time. Had we done something like this, wiped this inducement, then went on to make a new high, the next time we come down here, the likelihood of this demand is a lot less likely to hold. And I'd probably be looking at running it. So that's the whole concept of liquidity and inducement, and it's basically used to move the market, and we're either using it or we're targeting it. So I won't drag this video on too much longer. The next videos will be on changes of characters and supply and demand flips. I'll see everyone there.